Good afternoon, everyone. My name is David Scherer, Co-CEO, Co-founder, Origin Investments. That was our legal disclaimer. I hope you had a chance to read it. We have to do that now. We're going to begin the webinar. This is a QOZ investor update. I'm joined by Chris Neumann out of our Nashville office. Chris, for the 6 years. I'll cover the high portfolio level summary, cash flows, state of the market. Chris is going to go into much more detail on assets. We've chosen 4 of our developments in QOZ that we'll go much deeper on. He's one of our leaders in our investment management team. And Chris, I was thinking about this morning. I think that where you played basketball is one of the few colleges in the country that has less NCAA berths than Harvard, where I went. Is that accurate?
I haven't done that math, Dave. You stumped me on that one, but I'm willing to bet that's the case. So,
Yeah.
go Harvard.
It's my goal every webinar, live TV, to throw something at you that you're not expecting. So I can guarantee you he wasn't expecting that.
That's for sure. Yeah, thanks.
And I'm pretty sure that your college isn't eligible for the NCAA either. So I'm not even being fair, right?
That's true. Yeah,
Yeah.
we're in Division III, but someday
Uh,
maybe we'll go head to head.
and it's also true you played there, and I'm not skilled enough to play at any college level of basketball.
We're both
Which
athletes, though.
is
That's a
also
win.
all right. So we're going to jump right in. So when we started investing this fund, just to give you an idea, I'll just start from the top. Interest rates, the risk-free rate at the Federal Reserve level, their target SOFR rate, used to be called LIBOR, was about 25 basis points, 0.25. Now it's 5.25 to 5.5. So to put that in context, that's the largest increase in interest rates as a percentage in the history of our country. And it's one of the largest in an absolute sense, because obviously going from 0.25 to any number is a big percentage move. But just a 500 basis point move in the amount of time we're talking about is a lot of movement. And so that is pretty extraordinary. One of the questions we had was about our interest rate hedging. We did do a lot of interest rate hedging, and it was very accretive to this fund. I'm going to double check with Mark Turner. I know that he sent me. I asked him exactly the amount, and I'll double check because I don't want to misspeak. When Chris is presenting, I'll get my exact amount, but it's in the millions and millions of dollars that we saved, and I'll get back to that later. Okay? So we were very proactive about hedging these risks in a way that a lot of other managers weren't, and you've benefited from that. But in macro, I've been in investing initially in arbitrage derivative investing, but for the last 20 years in real estate investing, I've never seen interest rate movements like this in my 30-year career. So it's truly new territory. And even now, the interest rates are very undecided. The 10-year note yield was 3.5 6 months ago, and as of today, it's 4.3. So it's still moving a lot. The front of the curve is a little more stable, meaning the Fed is probably towards the end of its rate hikes. Might do 1 or 2 more, but isn't probably going to do a bunch more. But what's uncertain on the front end is how long they'll leave rates at 5.25. Increasingly, it looks like longer than people thought. And then on the longer end of the curve, which candidly affects us equally as much, because when we refinance assets from construction loans in the long-term borrowing, we really are looking more at the 10-year note yield. So that's very important as well. We will keep you apprised of interest rates. Those are something that we can't control. But I do believe that we have done a better job than, I don't want to say all, because I don't know what every manager did. But I think certainly most. I don't think many hedged their interest rates at all. I'm going to move on to supply. You can go back to the last slide, please. So supply is really, again, what's interesting about supply is it's a function of interest rates. Why? Because when interest rates are very low, there's just a lot more activity in development. Developments tend to pencil. They tend to look like they're going to be viable. Um, the margins are high, and so it tends to increase supply, and that's exactly what happened in 2020 and 2021 when the Fed was keeping interest rates artificially low, um, actually the lowest we've ever seen, right? Sub 1%. A lot of new construction was started in multifamily. And, depending on the type of construction, it could be, anywhere from 24 to 48 months to build in a normal market, depending if it's stick build or wrap or podium. Um, and we're about 24 to 40 months later. I mean, this is about that time and the supply is hitting. And so there's a lot of supply, and we'll see this slide in a moment, that's hitting in 23 and then into 24. And so the market has to deal with that, and that's creating less rent growth or even flat negative rent growth. But I don't want you to be alarmed by that. We don't, that's sustainable. We have a housing shortage in the US. This oversupply in the next 18 months won't cure it. And then importantly, looking forward, there's actually very, very few new developments starting. And that shouldn't surprise you either, because interest rates are much higher, but also post SVB bank failing and all of that pressure on the regional banks um, to sort of hoard deposits and really manage their balance sheet. Banks are just lending a lot less. And in a way, they're helping the Federal Reserve quite a bit because they're taking out money supply too. They're not lending it, so that they're shrinking it as well. And what you'll see is in 26, 27, you're going to have a lot less supply. And so, the arc of this investment will be as we deliver in 24, 25, 26, we're actually going to be in a very strong rent growth environment. And our machine learning, which, just to give you an idea of the credibility of this, it takes in 3 billion pieces of data a month. It's been incredibly predictive. Now, how predictive? It predicted that there'd be really strong rent growth in 21. Not strong in the sense of, to give you an idea, historical rent growth over the last 100 years is 3%. That's what it historically grows annually. We were predicting in 21, 15 to 20%. So that's, 4, 5, 6, 7x normal. It wound up being 30%. In 22, we predicted strong rent growth that flattened in Q3 and 4. That's exactly what happened. In 23, we predicted negative rent growth. How rare is that? It's happened 4 times in 100 years. Spanish flu, Great Depression, hyperinflation of the 70s, and Great Recession. This will be the 5th. And we predicted negative rent growth based on multilytics, based on unbiased data. And what has happened in 23? We've seen negative rent growth. It's right again. And what multilytics believes going forward, 24, 25, 26, is again strong rent growth. We're going to see that transition from weak 23 to flat Q1, Q2, 24, and then strong 24 second half, 25, 26. So I'm not bearish at all, and I don't want you to have that conclusion. This is a long-term investment. We've still created margin in the development phase, and I'm really proud of our team. Chris is a leader of the team of creating margin in a world where we were stress tested. Make no mistake, when we create pro forma models and undergo development, we're using scenario analysis, and this is the stress test analysis. What's happened? Like, what would happen if interest rates go up 500 basis points and there's an oversupply and construction costs are high and rents aren't growing that fast, but your expenses are? What would happen? Well, it happened, and we're still delivering margin for you. We're still protecting and growing your money. And I'm very proud of that, and you should feel good about that. Going forward, we will have wind at our back at some point. multifamily is too strong of an asset class. It won't remain in this environment. I'm going to move on to the third point, which is operational NOI. You can go back to the last slide. And I'm sort of touching on this a little bit, but 23 is largely about flattening rent growth into negative rent growth. That's your revenue side. And then on your expense side, you've had this lag effect of growth inflation. And in particular, one area I'll focus on. I mean, certainly it's in the wage area, so at all level of wages. So whether it's construction wages, operating asset wages, those are higher, but that's sort of, in that 3 to 6% range. What's really higher is insurance. And, I could go deal by deal, but in some of these coastal markets like Florida or Texas, we're not seeing 5 or 10% rent growth. We're seeing 100% rent growth. I'm sorry, insurance rate increase. And so a lot of it is the in all forms, not just hurricanes, but lots of wildfires that have been quite large. There's just more extreme weather than there's ever been, and that's a worldwide thing. The other thing that's happened is insurers, when they were underwriting their cost of insurance, ultimately they want to make money. They weren't pricing in inflation in their replacement costs. So their actuaries 5 years ago, 3 years ago, they weren't pricing in that if they had to replace a building because of a hurricane, it wasn't going to cost 50 million, it was going to cost 80 million. And that's what's happened is now they've looked at this again and said, wait a minute, we were wrong. We need to catch these up so we can be in a position to make money again. So I don't believe that these increases in insurance, are going to come back down. I think this is the new price of insurance, but I also don't believe they're going to keep going up. I think this was a one-time repricing, and now you're going to see that it'll enter sort of that normalized inflation rate again. But I don't believe that I'm going to be on a webinar with you in 6 months and say, well, actually, the insurance went down 30% because it had gone up 80%. I don't believe that's going to happen. So we're in this weird environment this year where revenue growth isn't really going up, but expense growth is going up. And then the last thing I would tell you is multiples. And that's not on this slide, but I'll just mention it. When your interest rate, when your borrowing cost goes up as much as it did, the discount rate, and many of you that follow tech stocks, this was sort of the 2022 explanation of why tech stocks were repricing while their earnings weren't going down. And I don't know if anyone followed this, but a lot of the explanation was it's the discount rate. It's because when interest rates go up, we're discounting future cash flows at a higher rate. And therefore, even at a constant EBITDA, a stock can be, or a growing EBITDA, a stock can be worth way less at that higher discount rate. That's what's happened to our cap rates because our borrowing rates have gone up so much now that capital is demanding a higher return, and that higher return is a higher discount rate. And so at every unit of earnings, your building is worth less. So we actually have buildings across all of our funds, not just this one, that have much higher earnings than they did 2 years ago, but they're worth less because the multiple on those earnings have gone down. But I don't believe that will continue to happen. I think that right now we're plus or minus a 4.75 to 5 cap, and I think that feels like a pretty fair level. That's 20 times earnings. We got as high as 30 times earnings, and that probably wasn't sustainable. Next slide, please. Now I'm ready. This is just the so into time, and this is something. What's important about this is in every model, including all the models that we use to price the deals in this fund, we build in the SOFR curve because that is a component of our borrowing rate. During construction, our loans are priced over SOFR. So if I ever say, or Chris might say later, oh, this loan at Mira is 235 over SOFR. 235 is the risk premium spread, and SOFR right now is 5.25. right? So you get the total loan as the summation of the two. So what we do in the model is we just build in the SOFR curve. We don't assume we're smarter than the worldwide market for interest rates. They cumulatively believe this is what's going to happen to SOFR over time. And so we build that in month by month into our borrowing rate, leaving the 235 in this example at Mira, but the SOFR can move. And as you can see here, right now we're 5.25 to 5.5, and the market believes that it's going to over time, get to 350 to 400. So that's 3.5 to 4%. SOFR. This is very different than even 8 months ago, where it would have been a steeper decline from 5.25 to 5.5, and you would have wound up lower faster. And basically, over the last 6 to 12 months, the market has started to come to the belief that we're going to have higher interest rates longer, and obviously that means we borrow at a higher rate longer, which isn't good. I can also tell you that the SOFR curve, it's efficient in the sense that everyone gets the same information and they price it, and that's what they believe today. It was also completely wrong in 2021. It couldn't have been more wrong. So you had an efficient market that was fully wrong. If you had looked at this SOFR curve in 2021, it would have shown you 2 years of essentially 0 to 0.25 interest rate. And now we're 5.5. So I would say that's quite wrong. So this is not gospel. It can be completely wrong. It can be somewhat wrong. It can change and does. But I am showing you the snapshot of what an efficient market that has information and trades every minute of every day believes now, as of today. And I can also tell you we use this curve in our models for our interest rate costs if it's variable rate debt. And most of our construction debt, actually all of it, is variable rate debt. Next slide, please. I spoke to supply earlier. This will kind of drive that point home. But if you think about where we were in 2018, 19, 20, 21, 22, we were kind of bouncing around at 350,000 new units. And by the way, one thing this slide doesn't tell you is 350,000 units isn't enough. It's creating bigger deficits in housing. So that wasn't enough to reach equilibrium. And you can really see what's interesting about this. If you go further back to kind of that 09, 10, 11, 12, that's when the housing shortage happened, right? Because you had basically 3 years where very, very little was built, and we never really caught it up. We're about to catch it up a little bit, but it's not going to fully solve it. It's not even really coming close to solving it, because even in 23 and 24, where you have 200,000 more units than you did the years prior, so you're making up 400,000 units, we're anywhere from 2.5 to 3 million underhoused. So this might mitigate 10%. You're still left with 90. But it isn't solving the long-term housing problem. But what it is doing, and we're seeing it, is you have to absorb all those units. And so in the short run, especially in certain markets, there's just an awful lot of supply that's hitting. And it shouldn't surprise you that it's happening about 2 to 3 years after a zero interest rate environment, which is 20 and 21. If you just fast forward, 23, 24 is exactly 3 years, and that's when it hits. And then you see it normalize. That was 22 starts. So now it normalizes back to kind of the normal. We don't have 26 data on this slide, 2026, but it's going to be incredibly low. And that's what I was speaking about before. New multifamily transactions and starts are down over 50%. So, if you were doing roughly 400, I would expect 2026, and, hold me to this, eventually we will have this data. It'll be 200,000 when we finally talk about this. And that what that'll do is give us a lot of pricing power as people continue to move to these cities, but there aren't new deliveries to satisfy the demand. And that's also what our machine learning is picking up, right? All this is sort of consistent. You can get there logically or through data. Next slide, please. Here's the portfolio, 309 million of NAV. We haven't flowed the share price yet. We did get a question on when we do that, and we'll do it in September. So as of 9:30, that share price will float. And we anticipate that it'll be higher than the 10 at that point. So that's an answer to the question that was emailed in. Common equity versus cash and other marketable securities. The common equity will go higher as we deploy it in the developments, and Chris will give you an update about where we are in deployment. And the other thing that you should realize, if you don't, it isn't binomial. It isn't that it's either sitting in equity or it's deployed. In development, what happens is it's called over time as construction proceeds, and then there's a process by which we approve construction and then release money once approved through title. And so, that money is released over time. Like in a given week, Chris might email me in this case 5 times and say, XYZ development requires, a $380,000, and this is the itemization. And I mean, it's one of the things that he and his team do is they have to go line by line and approve these things. So my point is, we don't get from 45 to 100 because 2 deals break ground. It takes a year or more to reach the point by which it moves from one to the other. And then the geographic diversification we're very proud of and pleased with. I mean, this is indicative of obviously why you partnered with us. You wanted exposure to Colorado, the Southeast, Florida, et cetera. And so, this fund is certainly doing its job there. And leverage ratio at 64 is also exactly what our target is. That leverage ratio is based on loan to cost. We expect that to come down as we build value and margin through the development phase. But 64 is a good leverage ratio. We're sort of right at our target. Next slide, please. This directly answers a question that we get a lot in a lot of different forms, but thank you for emailing in your questions. And I'm trying to integrate a lot of them into my presentation, but you can also ask them again in live if you don't feel like I went in great enough detail. So we spoke about all the headwinds, and I even used the word stress test. And this has been a stress test environment. And I'm actually really proud of the fact that we've still created significant margin, meaning we've made you money in a world where if we hadn't done our job, that wouldn't have been possible. And the job starts with selecting the right assets, being very diligent about your underwriting, being conservative about your underwriting, and then executing. And so where I would focus here, obviously just starting with the percentage of funds value, the larger that is, the more material it is to the fund, right? So Sawtell and Dorian are very material to the fund because they're 11 and 9.8%. District West isn't that material at 1.9. But the other place I would focus, and this is really probably the most important, is the pro forma multiple at stabilization. And to be clear, what that means is after that sort of 48-month, 40-month construction period. So if you invested $1 million, we believe that it would be worth 1.75 million after the construction period. That's when I say the word margin or building value. That's what I mean. Is you are benefiting from our expertise, market selection, execution during that period. Because candidly, after that, there's still work to be done, but it's now a leased, built, cash flowing asset, and now we're operating the asset, but it doesn't require the same amount of skill and expertise to operate than it does to build. And so if pro forma is 1.75, in this case, St. Augustine, the revised multiple is 1.73 to 1.83. And that takes into consideration that 500 basis point increase in interest rates. It takes into consideration construction cost inflation, insurance inflation, flattening rents, cap rate expansion, like all the questions we get Well, what about this? What about that? They're all baked into this revised multiple stabilization. So if you have any, because all those questions are getting to one central question. How am I doing? And how you're doing is the revised multiple stabilization versus the pro forma. And in general, and you'll see, you're not doing, I mean, I'm not going to sugarcoat it. 5, not 1.7. So it's not as good. Why? Well, in this case, Two Rivers is in Tampa Bay. Tampa Bay, we watched insurance go from 500 a unit to 1,500 a unit. No one could model that. That's not something you would ever model, even if you live in model 550 to 600, not 1,500. So there's a lot of things here that were difficult to impossible to predict. But I'm very pleased with where you are, and you as an investor should know a couple things. One, you've made money during the construction period. And we're quantifying, I won't go deal by deal, but you can review this and we'll email this to you as well. You're doing quite well. And then the other thing is this multiple doesn't take into consideration the last 5 to 6 years of the fund where you're cash flowing the deal, and historically real estate goes up 2.5% to 4.5% a year. And that's also creating multiple, right? Because that's, if you just multiply that by 5, so you've got a cash flow component and an appreciation component that isn't factored in here. So if that's not clear, we can go over this more in Q&A. But I really feel like a lot of your questions are driving at a bigger question, which is how am I doing? And this slide is very important and tries to address all of those things. And I would focus on revised multiple stabilization. That is our belief of where you are today. And that will ultimately be rolled up into the NAV of the share price itself. It's fixed now at 10, but it'll float as of 9:30. Next slide, please. So the cash flows are another thing I get a lot of questions on, and either it's a question about, hey, what are the cash flows, or it's, am I going to have money to pay my original capital gain? Those are kind of the two questions that come in. I've been advising for the last, 3 or 4 webinars. Please have your tax planning not dependent on cash flow from this investment. And the reason is for your capital gains that are due, when they're due. The reason for that is I can't predict interest rates. When interest rates were 1 or 2%, there was a ton of cash flow. Now that you're borrowing at more like, 5.25% to 6% on fixed rate debt, there's much less cash flow. Where are interest rates going to be in a year and 2 years? Because that's when your capital gain, that's when that becomes more relevant. The capital gain is due at the end of 2026. I don't know where interest rates are going to be then. So I don't want to advise you one way or another. This snapshot is where cash flows will be as of today with the current interest rates that we see. And the spikes you see in cash flow are due to refi. So there's a lot of deals that are being modeled to being stabilized and refinanced in Q2. And again in 2027 Q1 and then again in 2028 Q1. Even that, it's an art and a science. I can't tell you it's exactly going to be Q2 or Q1 2027, but in general, the cash flows are lower than we modeled. If you've been watching these webinars over the last 18 months, solely because of function of interest rates. It's just much more expensive to borrow, and that money, when it goes to the lender, can't go to us. And then to a lesser extent, there's also higher operating costs, which also, are used for cash flow. I believe that's my last slide. Chris, is this yours?
This is me. Yeah. Thanks, Dave.
All right. Thank you.
So we'll cover 4 properties today, and we'll start at Mira, which is our 288 unit, 7-story podium project located at the gateway to Raleigh's southern downtown. As you can see, we've got some drone footage here. we've made considerable progress in recent months. Wood framing is nearing completion across all phases. We only have a small portion remaining near the Sky Lounge area. Window and Tyvek installation will be completed this month. And so we've shifted our focus on interior build out. Unit mechanicals, electrical, and plumbing rough-ins have begun. Our construction contract buyout is at 99%. So we don't view any cost increases as a risk to this deal any longer. And as you can see above the drone footage, our branding package was recently finalized. The property is going to be called Mira. And so with this, we will start to think about pre-leasing as we get excited about first move-ins during the first quarter of 2024. And once complete, this project's going to offer extremely strong walkability. It has a walk score of 85, which I believe is probably one of the highest in our portfolio, but it also maintains a private feel that'll be different from any other downtown Raleigh multifamily community in the market. It's just 3 blocks from the Fayetteville Street corridor, which is home to the Triangle's most dense urban employment hub. Additionally, we're only 1 block away from the Duke Energy Center for the Performing Arts. And so we anticipate resident demand from this attraction. And we're a half mile from Raleigh's Warehouse District, which is a very cool node with historic brick buildings that have been transformed into a vibrant mix of office, residential, and retail. So lots to do within striking distance of Mira. We're extremely excited to deliver this asset to the downtown Raleigh market sometime early next year. Next slide, please. Revolve at Ballpark Village is a new fund asset. This is a 355-unit garden multifamily project located just 20 miles west of downtown Phoenix in a suburb called Goodyear. This is the second phase of a multifamily development that'll be completed by our investment partner in this location. So they're extremely familiar with the area and the local development process, which we're excited about. Goodyear as a suburb is booming. It's one of the fastest growing cities in the Phoenix metro area. This site is also extremely close to the spring training facilities for the Major League Baseball, Cleveland Indians, and Cincinnati Reds. It's right down the street, along with a new 86-acre recreational campus that's tucked in between the two ballparks. And so plenty to do right outside of our front doors. As it relates to construction and being able to move forward on this project, our designs have been finalized, our permits are ready to go. We're just in the process of putting the bow on our construction budget with our general contractor, and we're working through loan documents with our lender. And speaking about our lender, we're extremely excited about our debt execution on this deal. In an otherwise challenging market, we believe that we've unlocked terms that are outside of market at 65% of our total construction costs. We believe that this speaks to the overall strength of our sponsorship that's developing this deal. And so we're hopeful to break ground on this project in the next 30 to 45 days, so long as all goes to plan. And very excited about the renderings that are placed on the slide as well. So next slide, please. Sawtell is our 40-acre site located in Atlanta's Chosewood Park neighborhood, which is just 3 miles south of Atlanta's central business district. And additionally, it's very proximate to the extension of the Atlanta Beltline, which will allow for our site to have connectivity to all that Atlanta has to offer, within just a few blocks of our project. And as mentioned, with 40 acres, this is a massive site. It's simply not feasible to develop all 40 acres at once. And so we've opted to break this project's construction into multiple phases. And we're full steam ahead on phase 1. We're moving through design and permits. This phase is going to consist of roughly 360 units of multifamily project, 85 for-rent townhomes, and roughly 12,000 square feet of retail space. And previously, we considered that a portion of phase 1 would include a community club with state-of-the-art amenities, but we've made some recent changes in response to the capital market conditions and some construction pricing feedback that we received a few months ago. And so despite making a minor shift in plan for phase 1, we were still able to maintain our permitting process with the city of Atlanta. We didn't lose any pre-development schedule because of this change in site plan. And we were very confident that this selected mix of traditional multifamily units, for-rent townhomes, and some retail is going to create a more traditionally sized project that will respond to this challenging lending environment, while also introducing some higher yielding townhomes in place of the club, and reducing the potential cannibalization by relocating one of the multifamily buildings that was originally planned for phase one over onto the second phase. And so we're gravitating away from the club type concept, but we're still going to provide ample community amenities, both within the residential residential buildings, but also the surrounding parks, with an emphasis on the streets and neighborhood connection to the local chosen park neighborhood. So as it relates to construction, we're preparing to begin demolition of the existing structures on site this month. So we're again moving forward full steam ahead. And after that, site prep can start before the end of this year, once we receive our land development permit. And looking ahead, we anticipate that vertical construction permits will be received sometime early next year, likely in the first quarter, and will allow us to really get moving here at Sawtell. So excited for what's next there in the coming months. Next slide, please. Rise St. Augustine is our 272 unit build for rent project, which is located just 45 miles south of Jacksonville in the St. Augustine market. Once completed, this project is going to consist of a mix of 2 and 3 bedroom townhomes with attached garages, and it will also include a central clubhouse with a full slate of amenities. Currently, we're moving through our drawings with our architect, and we've issued our second round of drawings back to the city. But we've reached a bit of a bump in the road with the city of St. Augustine and St. Johns County, as they're currently expressing that we're going to need to upsize our utility and fire system in order to meet their city and county standards. This has the potential to increase our construction costs by roughly $5 million. Again, this would be to upsize utilities, perform additional site work, and then add a fire sprinkler system to all of our residential buildings. And so to clarify, these are municipally directed changes that are increasing our construction costs. It's not material price increases, but we're in discussion with the city in hopes that they're going to reconsider their stance on private versus public utilities. And we're also speaking with the county fire marshal office to better understand pipe sizing and their stated requirement for sprinklers throughout the building. And so we're hoping to reach a consensus there in the next couple of weeks. Despite the potential increase of 5% to our total construction budget, multifamily rents across St. Augustine have increased by 3.5% over the past year, which certainly helps to offset any potential impact to increase in construction costs relative to our underwritten pro forma. But with that, we're in discussions with a prospective construction lender in hopes that we can reach terms with the lender, but also get to a consensus with the local municipalities, be able to finalize our drawings, and then begin construction before the end of 2023. That's all I've got, Dave.
All right, thanks, Chris. I believe did you write down, I know you answered when we discussed a couple of questions that were emailed in. Why don't we start with those? And by the way, please use the Q&A for your questions. We have 5 live questions, which I'll answer once. Chris, why don't you answer a couple that you chose prior?
Yeah, sure, absolutely. One of the investors asked, are construction costs coming down? What do you foresee for the next year? And so across our portfolio of new developments, and as we're receiving bids from multiple general contractors, we've not witnessed that construction costs have declined. However, we have noticed when we're preparing to move to contract stage, general contractors are proposing fewer allowances, and the contingencies that we're carrying within those construction budgets are generally holding true. And so it's possible that in the next 12 months, construction costs could decline, but in our opinion, it's more likely to occur by way of material prices, as some of these contractors recognize that the supply or kind of the supply pipeline is starting to dry up. But we do believe that labor is likely to hold at where it's currently at. And so we're not forecasting any decline in construction cost pricing at this point. Another investor asked if we've had to deal with any of the construction labor shortages in Florida due to the immigration crackdown in that state. Yes is the short answer. We have seen manpower impacted in certain trades, but in particular drywallers and roofers. But with that, we've been working much more closely with our subcontractors to, one, ensure that they're scheduling out their projects accordingly, that they're not stretching themselves too thin across what they've committed to, but also to ensure that their workforce is properly documented to the greatest extent possible. But we're also realizing that although the law was passed, it doesn't actually impose any new regulatory requirements. It appears that it was passed as more of a political gesture than an actual attempt to enforce immigration reform. And so, although we have seen an impact as of late, we don't anticipate that it's going to be something that will be long lasting unless the law becomes more of a higher priority. The other question was, please talk about debt and interest rates on existing loans plus new projects where you haven't borrowed yet. And so there's 3 projects that we have broken ground on with our construction lender. All 3 of those are at leverage points that are north of 60%. So in kind of the 62.5 to 65% loan to cost, which again, we view as kind of out of market, and their interest rate spreads are likely below where we could capture for any new project that we break ground on. And so as we forecast pro forma the projects that we've yet to break ground on and are in negotiation to begin construction, we're estimating that the overall loan to cost across new deals will be somewhere between 50 and 55% at spreads that approach 300 basis points. And so we're thankful that we've broken ground on those 3 deals, but it's likely that the leverage points are moving south as we look ahead.
Thank you, Chris. I think those were the 3. So I'm gonna start with live. Thanks for sending them in. First question from Phil. Thanks for your question, Phil. And another fund had to rebuild. No, we've never had to rebuild. We have had small situations. Oftentimes there's fires at units. It happens a lot more than people think. Generally, it's dryers that are causing them, and it damages 1 to 2 units. Insurance covers those things, but we've never had an actual property loss. We've had damage to some units. And yes, if we had a full loss, we would rebuild. That would be the plan. We're fully insured. So that's what we would do. I'm going to move on. Evan has a question. Thanks for your question, Evan. He's looking at a multiple of 1.35. I don't know which deal this pertains to, but his question is 1.35 multiple is less than 10%. Do you expect that to increase significantly? It's hard to know if it's less or more than 10% unless you know the duration the money was out. But you're right. IRR plus time equals multiple, and I think that's what you're driving at. In terms of expectations, I don't make predictions about where things will be in the future. What I expect is our team to continue to outperform other teams, which I believe we've done in the last 3 years, and I think we'll keep doing. What I can't control is the environment. I don't know what some of these macro trends will be, but we have created significant value, and we'll keep doing that. I'm invested heavily in this fund right alongside you, and I want the same outcome as a manager and an investor. So, but I can't tell you what I expect. I think it's probable that rents, and our machine learning believes that rents in the second half of 24, 25, 26 will be quite strong, and it'll provide tailwinds for us in those times. I don't have a real opinion on interest rates. I know lots of people have really strong opinions either way. I don't. I think a 4% interest rate is not high or low. And I think SOFR, unless we go into recession, probably stays at where it is for longer than people think. That's my opinion, but that's not Origin's opinion. So I don't want to project that. We had a anonymous question about deliveries that says, it seems like deliveries will decline in 26. Why is Origin able to start new projects when others are pulling back? A couple reasons. And I actually believe this is a good time to start because you're going to be delivering into lack of other deliveries, when you're coming to market. So it's probably a good time to start. The reason is we are able to find deals that are high enough margin that they still make sense at higher interest rates. And to Chris's point earlier, which is an important one, at lower leverage points. And so in general, if you're borrowing only 50 or 55% to capitalize a deal, it's very hard to make that deal make sense on a levered basis so that you want to do it at all. The required return on equity is higher than what you're able to deliver, unless the margin at the deal level is high enough to start with that you don't need high leverage points to augment it. And so kind of a long way of saying, because we've been in our markets 10 years and we have great relationships and we believe we understand good real estate, good deals, good underwriting, we think that we can still find a few. And that's important too. We're not looking for 50 deals, we're looking for a few. This fund isn't that big. None of our funds are that big. And even as we've grown as a manager, we don't grow really in size of funds. You should notice that. Our first QOZ fund was 275 million. Our second was 305 million. We're not growing much because we believe that we want to stay, sort of small, agile, nimble. One or two deals really move the fund. Not we're looking for the next 30 deals. That would be very hard to find. And then the last thing I'd say is we have deep lending relationships. So, we can't borrow at 60%, but at least we have access to credit at 50 to 55. There's a lot of firms that don't. And that's based on long-term relationships. And importantly, being a good partner to your lenders too, right? We try to be good partners to our equity partners, that's you, but we're also good partners to our lending partners. They are a partner in the deal to capitalize the deal. And they've done well investing alongside of us, on the debt side. Evan asked another question. Thanks, Evan, about water supply issues, specifically in Phoenix. And you're absolutely right that has become an issue. And in certain areas, it's even become restrictive and a higher cost to do business. That's not a factor in any of our deals. We certainly have had challenges, but this isn't one that has affected us. We're fine in that aspect. But thanks for the question. It's certainly something that we monitor, but our projects are not affected by any of the changes that are in the municipalities around water. John asked a question, Chris, about QOZ reform. And thanks for your question, John. That came in a lot in the question sent in prior as well. No, I haven't heard anything. And I wouldn't count on it, and it doesn't seem likely to me at this point. We'll keep you apprised, but I don't believe that it's likely to happen at this point. Phil, this is a comment. These webinars and your statements on multiple points reaffirm my confidence in this long-term investment and my decision to partner with Origin. Phil, thank you so much. That means the world to me. We really do work extraordinarily hard to protect and grow your money, and we'll keep doing that. And I'm very confident in the outcome of this fund. And I said it before, but I'm gonna be redundant. The margin that you've created in this environment is extraordinary. And I know, and I agree with you, because Evan, you had a different perspective, which is, I want a higher return for development. I do too. But even in your example, you're getting 10% in a 3 standard deviation move against us in underwriting that no one could have predicted. You're still growing money. I'm proud of that. That's my perspective. I also don't believe those headwinds will maintain. I think we'll have plenty of webinars where we're doing a good job, plus the market's going our way. That'll happen too. We're partners in this for a long time, and we're going to manage risk. We're going to keep your money protected and growing. John asked another question about pref equity. Will the fund need to take on pref equity? No, it won't. We don't tend to want to use preferred equity. But to Chris's point, because we're not using preferred equity, we're using less leverage than we had modeled initially. And by the way, that's not all bad. Like you can focus on, oh well, the IRR is lower because you're using less debt. That's true, but so is the risk, right? An unlevered return or a lower leveraged return is inherently much less risky than a higher leveraged return. And so, yes, we're using a little bit less debt, and yes, it's lower risk than we anticipated. So it's not always bad. You have to think about the benefits of low leverage too. I don't have more questions. If you have any more, because we have 8 more minutes allotted. If you have any other questions, I'll just hang tight to see if any others come in. We are committed to transparency, as you can see. Any questions that come in, I'll answer.
Hey, Dave, I see one other question up above that came in from an anonymous attendee. I can answer it.
Okay, great. Thanks.
Asking about the multiple at stabilization for Revolve not being listed on one of the previous slides. The reason for that was that slide was representing fund deals as of 6/30. Revolve at Ballpark Village was added after that date. So you can expect that moving forward, Revolve will be on that along with its underlying returns. But the question also asked about Goodyear. It's whether it's far west of Phoenix and what are employment growth opportunities in this area. So it's 20 miles west of downtown Phoenix. And if you're familiar with Phoenix, it's a pretty sprawling MSA. It's similar proximity to Chandler or Gilbert to kind of the downtown CBD. But as it relates to the specific Goodyear area, it's a booming distribution and kind of warehouse node, as it's situated ideally along Interstate 10, which will connect Phoenix to Los Angeles and Interstate 8 down to San Diego. And so we're really excited about the job fundamentals in Goodyear, and we believe that our property will feed off of that.
Thanks, Chris. We had two new questions in the comment. John, thank you for your kind words. I appreciate it. We really value as a partner. And Chris had a question. Can we use the last 5 minutes to go over all the other deals that Chris didn't go into detail on? And Chris had time to do that, but that doesn't mean that I'm not available to do it. Please email me at david@origininvestments.com, and either myself or someone at our investment management team can take you through those deals. We value as a partner, but I have a feeling that's more of a half-hour event than I wouldn't want to go through all of those deals that quickly. With that, we did save you 6 minutes, unless there's any other questions. I mean it. Email me at david@origininvestments.com. I will schedule a call or set up time with one of our team members if relevant. Oh, there's one more question. 1 second. Oh, Evan. Thanks, Evan. I appreciate you reaching out and saying thanks for the update. We value you very much. All right. Have a great rest of the day, and we appreciate you as partners. Take care. Bye-bye.